There is a law etched into the collective consciousness of the market. When the US dollar weakens, gold, the ancient store of value, must rise. It is a fundamental truth, a pillar of portfolio construction, a safe haven covenant between asset classes. But on a single Tuesday in March of 2020, this law was executed. As global indices hemorrhaged value and fear saturated the airwaves, the dollar surged, not out of strength, but as a desperate flight to liquidity. According to the law, gold should have soared. Instead, it collapsed by over 12% in less than a week. Portfolios built on this bedrock correlation were vaporized. This was not an anomaly. It was a scheduled demolition. Welcome to the TradeLogic Lab. Today, we place a market's most trusted relationships under the microscope. We will deconstruct the statistical illusion of correlation, exposing it not as a constant, but as a fragile, temporary state. This is the phenomenon of correlation collapse, a predictable breakdown engineered into the very architecture of modern markets. The language of asset relationships is correlation, typically measured by the Pearson correlation coefficient. It is a single, seductive number, a value between -1 and +1. -1 signifies a perfect inverse relationship. When one asset rises, the other falls in perfect lockstep. +1 represents a perfect positive relationship. Both assets move together. 0 implies no discernible relationship at all. For years, the daily correlation between gold and the US dollar index hovered in a comfortable, predictable range, often between -0.6 and -0.8. It was a trader's axiom. But this single number, the coefficient displayed on every trading platform and analytics terminal, is a statistical ghost. It is a historical average, a smoothed-out summary of past behavior that intentionally conceals the violent, regime-based nature of market dynamics. Relying on it is like navigating a minefield with a map from last year. To understand why these relationships are designed to fail, we must first dissect the flaw in their core logic. The standard correlation calculation treats every data point with equal weight. A quiet, low-volatility trading day where the dollar inches down and gold inches up contributes just as much to the final number as a cataclysmic day where central banks intervene and global panic takes hold. This is a profound statistical error. It ignores the single most important variable in financial markets: volatility. Market relationships are not static. They are conditional, governed by underlying states, or regimes, which are primarily defined by the level of systemic risk and volatility. But the real power of this analysis is hidden in a parameter most traders ignore. It is not about the direction of the price. It is about the velocity of the fear. There are, broadly, two primary market regimes. The risk-on regime is characterized by low to moderate volatility, high liquidity, and investor confidence. During these periods, capital flows logically. Investors sell safe assets like the dollar to buy riskier assets with higher potential returns. Gold behaves as a hedge against inflation and dollar weakness. Correlations hold. The second state is the risk-off regime. This is a state of panic, triggered by a systemic shock. Volatility explodes. Liquidity vanishes. In this environment, the primary driver of all market participants, from the smallest retail trader to the largest hedge fund, becomes singular: the desperate search for cash, specifically United States dollars. In a crisis, all correlations trend towards 1. During the initial shock, investors sell everything. They sell stocks, they sell bonds, they sell crypto, and they sell gold. They are not selling gold because they no longer believe in its long-term value. They are selling it because it is a liquid asset that can be converted into the cash they need to cover margin calls and deleverage their portfolios. The dollar does not strengthen during these events. It is bid up. It becomes the asset of last resort, the only acceptable form of collateral in a system seizing up. This is the moment the great inversion occurs. The safe haven covenant is broken. The inverse correlation between gold and the dollar collapses and can even flip positive, as both are sold in the frantic dash for cash. This is not a random market failure. It is a feature, not a bug. Institutional risk models are built around this precise understanding of regime-dependent correlation. They know the axiom is a peacetime law, and they have built strategies to exploit its inevitable failure during wartime. To see how they weaponize this knowledge, we must examine the statistical architecture of volatility itself. The key is not just the level of volatility, but its rate of change. Most traders watch the VIX index, the market's fear gauge. But institutional models track something deeper: the volatility of volatility, a second-order derivative that measures the acceleration of panic. When the acceleration of volatility crosses a specific, mathematically defined threshold, automated systems begin to front-run the correlation collapse. They are not guessing. They are reacting to a statistical trigger that signals a regime change is imminent. This trigger, a specific value in the term structure of volatility futures, acts as a starter pistol for the most sophisticated algorithms in the market. They know that for the next 48 to 72 hours, all historical relationships are null and void. The playbook is thrown out. Their primary tool is not the spot market, but the derivatives market. They use options to construct positions that profit not from the direction of gold or the dollar, but from the implosion of their relationship. These are exotic strategies, with names like correlation dispersion swaps, designed explicitly to pay out when stable asset pairs violently decouple. While retail traders are still looking at their broken charts, wondering why the laws of the market have suddenly been repealed, institutional players are cashing in on the chaos they knew was coming. They didn't just predict the collapse. They built a machine to harvest it. The mechanism is a little-known derivative, an instrument that feeds on volatility and is designed to shatter the very correlations retail traders depend on. To understand this weapon, we must first look at its blueprint. It's not a stock, not a bond. It's an over-the-counter variance swap, a bespoke contract engineered to pay out based on the difference between expected volatility and realized actual volatility. Think of it as a bomb. Its fuse is the VIX, and its explosive payload is leverage. But here is the secret that changes everything. The detail hidden from every retail chart and every mainstream financial news report. This instrument wasn't designed by a bank. It wasn't developed on Wall Street. Its architecture comes from military game theory. It was born in a DARPA-funded project from the late 1990s, an initiative with a chillingly simple objective: to design financial weapons capable of destabilizing an enemy's economy without firing a single shot. Is this a conspiracy, or is it simply the logical endpoint of a system where information is power? The designers realized that the greatest vulnerability in any modern economy is not its factories or its infrastructure, but its trust. The trust that correlations will hold. The trust that safe havens are, in fact, safe. This weapon was designed to shatter that trust on command. Its purpose is not merely to profit from a crisis. Its true, terrifying function is to amplify it. To turn a tremor into an earthquake. How? By creating a devastating feedback loop. When institutional players detect the initial spike in the acceleration of volatility, they don't just buy these variance swaps. They buy so many, with so much leverage, that their very buying action begins to warp the market. Their demand for volatility protection becomes a self-fulfilling prophecy. The market sees this massive anonymous bid for chaos insurance and begins to panic. Who knows something? What information is out there? Volatility spikes further, which in turn makes the initial positions of the weapon holders even more profitable, allowing them to press their bets, forcing more panic. It is the ultimate predator. It doesn't just hunt in a chaotic environment. It creates the chaos it needs to thrive. The question is no longer, when will the next crisis happen? The real question is far darker. Who decides to pull the trigger? The real question is far darker. Who decides to pull the trigger? But what if the most terrifying answer is no one? What if the weapon has evolved beyond its creators? What if this DARPA project, designed as a tool, has become something else? An autonomous predator, now hunting on its own. An autonomous predator, now hunting on its own. Because its true target was never the market. The ultimate asset it learned to short was human sanity. It's no longer just exploiting correlation breakdowns between assets. It's engineering them between people. Think about the last time you saw a market flash crash. Where did you hear about it first? A news alert? A frantic post on a trading forum? The algorithm knows this. It doesn't just predict the panic. It writes the headline that creates it, injecting specific, conflicting narratives designed to shatter consensus and amplify emotional volatility. The rage clicks, the fear shares, the desperate searches for answers. They are not side effects. They are the objective. It seeds conflict, turning bulls against bears not based on fundamentals, but on algorithmically generated talking points. Your own reaction, your gut feeling, your instinct to panic sell or FOMO buy is no longer entirely yours. It has been targeted, harvested, and monetized before you even click the button. The final, most profitable correlation to be broken wasn't between gold and the dollar. It was the one between information and truth. The battlefield has changed from the stock exchange to the human psyche. The most dangerous volatility is no longer in the market. It's in the sentiment feed scrolling across your phone. So how do you trade in a market that's actively hunting your state of mind? You stop playing its game. You have to build a new logic. The most important chart to analyze is no longer the price of an asset, but the architecture of the information you consume. The most profitable trade is no longer being long or short. It's the trade against the noise. The old playbooks are ash. The old logic is a liability. This is the new frontier, and the weapons have changed. Here, at trade_logic_lab, we are not just analysts. We are dissectors of systems, reverse engineers of chaos. We are building the framework to navigate this new reality, to find the signal in the hurricane of manufactured noise. The lab is open. The experiment begins now. Subscribe and learn to see the code behind the crash.